How to make money when you're wrong about your analysis. Today's all about risk management. Yes, how to protect yourself from the downside so you can maximize the upside. And today we're going to use XRP as our example, a model that applies for all of your portfolios. So if you like today's video, like, subscribe, hit the bell notification. If you don't know me by now, my name is Jiggy. I'm the award-winning author of The Extraordinary Venture Capital Opportunity, How to Invest Like a Pro, been featured in the best-selling book, High Probability Trading Strategies, back in 2008, where I only used to focus on currencies, but now exclusive on cryptocurrencies. So let's dive straight in. So we did a video on XRP on the 6th of December. 6th of December, let's pull up a laser so I can show you. And we said, look, it's making a nice wave, 1, 2, 3, 4, 5 on the upside. We're calling that a wave 1/3. And it looked like a very clean A, B, C correction. So we said, is it looking like to smash the $3 mark? We had 3 targets, or 2 targets, one up here and one further up. And everything looked perfect for a setup. And this was the high-level macro thesis, the thinking based on Elliott wave and Fibonacci. But we can only do probabilities and never certainty. So I want to do an update of how this played out, how you could have still made money with whatever the scenario, and then where the market is looking like today. And by the way, today we're not going to do a deep dive into Fibonacci and the Elliott wave, but that's the core analysis. That's how we're getting these price targets, these price patterns, or the patterns, the momentum indicators. If you want to learn how to do it, dual momentum, which is all about the weekly and the daily pointing in the same direction. We had 2 degrees of pattern counts, ABC of a wave 2. We had Fibonacci retracements, alternate price projections, and other confluence of events, and we had some time as well. So basically, long story short, if you go back and watch my December 6th, which is up here, you can kind of click up here, watch the video, December 6th, and it had a nice clean breakdown of high probability setup. But today we're going to see how that played out, but how you can really get to the detail of managing your position from the downside. So if it does go your way, you maximize your position. And if it goes against you, which is always possible because we can only do probabilities, never certainties, you still make money. Either you make money, small profit, break even, or a small loss. And that's the name of the game. So the 2 targets with this was $2.14 and $1.05. $1.05. These are 2 price targets. This was our conservative, let's get risk-free price target. And this one was our wave 3, 1.618 price target. By the way, I teach a lot on Elliott wave, Fibonacci. I absolutely love it. You can take my free Elliott wave and Fibonacci masterclass. We've got a huge discount going on right now. My courses are normally $997. So at the end of the masterclass, you can decide if you want to kind of dive in. We're doing it for £97 for the full course. We break everything down from Fibonacci, from Elliott wave, and everything else. But take the masterclass, which is absolutely free, and I'll give you a high level, I'll give some golden nuggets of wisdom when it comes to reading the market. So what we're going to do here is XRP. I've done a zoom in to the chart that we did from the December 6th video. And what I wanted to get really, really clear as an entry strategy, because I've been listening to your comments, and everyone's got a different experience, right? Different experience, but you want to have a mechanical entry point. So what I do a lot of the time when I'm trading, if I'm trading in crypto or any financial product, crypto is where my main focus is I will wait for pattern, price, and time, but I'm also waiting for momentum. Yeah, the higher degree momentum, which means a weekly momentum is up, and I'm waiting for this over here. I think I've got it here drawn. Yeah, this over here. I'm waiting for the blue line to cross over the red, and then a good entry strategy, not the only entry strategy that I like, is after you get a bullish reversal, you literally say on the last 1 bar high, if the market takes you in and moves this way, you buy or you put in your order. And if it goes below the major swing low, then it stops you out. And this is going to be our risk. This is our risk. So the name of the game is you have to put down a certain amount to find out if you're right, if your analysis is on point. And if your analysis is on point, you make money. If it's not, you lose money. That's just the name of the game. It's a zero-sum game. They're the rules. They're the rules. So this is how it played out. All right, so I've just broken it down. So we're going to buy on a 1 bar high. I'm going to show you a spreadsheet that I've created that just makes it easy for you to create your business plan, manage your expectations. So what we're saying here, this 1 bar high, the price is 0.8475, so 84 cents, just over 84 cents. And the swing low, this low here, just below that low is 74.8 cents, right? So it's 0.748. And that's if you're using a stop loss. If you're familiar with stop losses, that's where your stop loss would go. And what I've created, this is very powerful. Students are finding this incredibly useful. Is a tool where you can just plug in some numbers. The yellow boxes, you just kind of go, what's my account size? So this example is you've had account size of $30,000. Your risk tolerance is 3% per position. So now you're risking $900. Now we're going to put in these bits of data here, which we're going to say is our entry point and our stop loss. We just put them in and it tells us, it says, all right, Jagir, for this position, buy 9,045 tokens. That's going to cost you 7,600. If it doesn't go your way and you get directly stopped out, sell those 9,045 tokens at the price of 74 cents, 74.8 cents, and you'll lose $900. So that's our risk tolerance. That's our risk management. We know the worst case scenario. But what we're doing here is we're saying, right, let's assume we're wrong. What's the minimum the market should do? Okay, let's exit 50% at that point. And what we're anticipating the market to do, which is more this $2.14, we want to hold the majority of our tokens for, because the big money is made in the big moves. So exit one target is here. And we're just going to type it in for what we said in the previous analysis, $1.05 and $2.14. And then what this does for us is it tells us, it says, Jagir, your risk in this position, if you decide to take it with the current setup, is $900. If it goes your way with exit one, exit two targets, you exit half here and half here, you'll make 6,700. That's a 7.5 risk to reward ratio. In other words, you're risking 900 to make this much, which is an additional 23% on top of your entire portfolio, 23% on this whole amount, right? So that's our business plan, high level numbers. And then you can decide, no, that doesn't meet my minimum requirements. Or you can say, yep, I always look for a minimum of 5-to-1 ratio, bang, this meets my requirements. So now, what happens? This is how I want you to think. Think about probabilities, never certainties, about your analysis, because it's literally, there's a chance that it's not going to pan out the way we're seeing it, right? That's technical analysis. Taking a loss is the cost of doing business when it comes to trading. And you want to have some of this. If you're using stop losses and entry triggers and everything else, but if you're not, you can still use this knowledge to just increase the probabilities of you winning. So this is how it played out, right? We got triggered into the trade. I'm going to draw it like this, and I want to keep it really, really clean and clear. Is we had an order here, we got triggered in here, and then the market moved a bit down, and it moved up here, right? And then with the momentum, we had the bullish reversal, we had a bearish reversal, and then we had a bull. And then over here, when it got to this point, we want to start trailing half of our position on a 1 bar low. So 1 bar low here, 1 bar low here, and then finally 1 bar low here where we got exited, right? So half of our position has been now exited in this example at 0.94. And I'm trying to get the thinking across, because why are we doing this? Well, you know, Warren Buffett's got that great rule. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is a practical implementation of that thinking, because what we're saying here is now that we've been stopped out for the first half, which is a good thing. We've made a small profit. It's nothing major, nothing to write home about, but we've got 0.94. We're going to put it into the spreadsheet in a second. But now we're also, this previous stop loss, which was down here, we're now going to move it to the entry point. We're going to say, hey, look, now we're going to move this to the entry point. And that's what this note is here. So stop loss on the remaining tokens, move to entry point. And it could, if you haven't got a stop loss feature, just put a price trigger in CoinGecko or CoinMarketCap. So if the price goes below this point, you're saying, I'm going to sell. So that now just means we're guaranteed a small profit on our first position, and we are break even, worst case scenario. So when we look at that, hopefully this is making sense, because I wanted to just do some risk management stuff, because I'm finding not many people do this, is what we're saying here now is this has now been triggered, right? Let me just pull this back up again. Let me go here. So this has now been triggered. That's been done. We've sold half of our tokens from the amount purchased at 94 cents, and we've put back $1,700 back into our pocket based on this. Right now, again, our purchase price was 84 cents, so it's nothing phenomenal. But what we're aiming to do here is risk management. And we're also saying here, our plan still, there's no other reason to believe that there's not a good probability that our second target should still be hit, $2.14. Doesn't mean it's going to, but in this now scenario, we've got our numbers. We say, okay, this is the numbers. Our original risk is now 900. However, now this risk goes to 0. Why? Is because we've exited half, and this initial stop loss over here what we're going to do is we're going to move it to the break-even point of 0.84. So now if I just go to the next slide here, I think I got it here. So if the market unfolds and as anticipated, we make some decent money. If it doesn't unfold as anticipated, if I just get rid of these, now what we're saying is this is our first position. That's done, right? That's been exited. But now we've moved our stop loss to the second position here. Now, if it does stop us out, it says, look, there's nothing to write home about. You're going to make $167. You're going to make 1% on your portfolio, and you're going to make, as a risk-reward ratio, 0.1 from the original risk. But at this point, there's zero risk because now we're risk-free because we've exited half and we've moved our stop loss. So this is just one of the best things I learned from one of my mentors was how to make money when you're wrong. So if you're stopped out and you can make money, it means you're in the game and you can play again and you can play again. Whereas if you're losing 3%, 5% every time you're wrong, then it becomes difficult. All right, so that's the analysis here. So worst case scenario, you make a small profit if wrong. That's the key lesson that I'm trying to get across here. So now with this particular market, right, this is where we stopped out our first position. We've moved our stop loss here. How did it play out? Well, it fully stopped out the position. Like it went further down, stopped out. So the summary was you made $167. You made you made 1% on your portfolio. We go, great. But there's nothing to write home about here. But the main thing is you would not have lost money. That's the key that I'm trying to get across here. So now with Elliott Wave and Fibonacci, I've just done XRP, just this morning, just an update. And if you want to learn how to do Elliott Wave Fibonacci, take my free Elliott Wave Fibonacci Masterclass. It's in the link below. I've broken this down step by step. But I'm just going to quickly cover this relatively quick because I want to keep it punchy today. This is a 1, 2, 3, 4, 5 sequence. That hasn't changed. That's pretty clear. There's other Fibonacci ratios that kind of confirms this. We got great. We're happy with that. Initially, my thinking was A, B, C. At this point, we had no other reason to believe that this wasn't a wave C of a wave 2. However, with the price going up, this was what we just did, the analysis on this point over here, where we basically made a little bit of money, nothing to write home about, but the market went further down. And as it stopped us out and made another low, what we have to do when it comes to Elliott Wave and Fibonacci, this is the reality, this is the day-to-day reality of it, is you have to reevaluate. So I've reevaluated. Weekly momentum is oversold. Daily momentum has made a bullish reversal. Now it looks more like A, B, and it's more of a 5-wave structure. 1, 2, 3, 4, 5 of a wave C of a wave 2, 5 of a C of a 2 of a 3. It goes. When you take my masterclass, I break down how to do degrees of counts. But on a macro level, now what we're seeing is a wave A, B, C. Now it looks like this is the higher probability C. However, there's a couple of things with XRP, and you want to be aware of this. When you're writing out your trade plan, which is a business plan, you'll have something like you only trade ABC corrections if it's at 50%, 62%, or 78.6%. So this is the typical maximum correction. It doesn't mean it can't go lower, but this is like the healthy maximum, and then there tends to be a 62% and a 50%. Now, clearly, this price is below this is here. This number here is the 78.6%. It's basically the square root of the Fibonacci ratio. These are psychological resistance zones. So what I would like to do is rather than having a high risk trade setup and entering down here, which has pros and cons, you can do it a few different ways, depends on your risk tolerance and everything else. I personally would see what's the biggest move to the upside in this whole sequence. It's this move here. I would like to see a price movement slightly bigger than that, even if it's 10, 20% bigger than that, and then wait for the first pullback. And this is a great strategy that you can mitigate your risk against, is when this movement here is a little greater than the greatest movement previous, it's called an overbalance of price. And this is one of the first signals that there's been a trend reversal. Doesn't mean it's guaranteed, it's just a nice, clear signal. And then what you can look for is for the first pullback. The first pullback, which I've drawn a box here, and if this breaks down to like an ABC structure, this down here, an ABC structure, then what you're looking for, that's supposed to be a C. Let me redo my C. See, what you're looking for is a nice entry point here, so you can get in quite low. So again, what you're looking for always is high probability setups with minimum risk. Is what you're anticipating is that same $2.14 target. That hasn't changed. Or it hasn't changed by much, right? So we kind of go, we're looking for that big move to the upside, big move to the upside. And if this holds, we anticipate this will be our stop loss position. But at the same time, we'll be looking to get risk-free in this kind of zone here, risk-free. Let me put it RF, risk-free. If the market goes here, risk-free, because it can go further down, right? We're not anticipating it, but you want to kind of work onto the downside. So today we covered, it was all about risk management. I told you, like, every day, right? Every day you see my video, I'm featured in the best-selling book, High Probability Trading Strategies. When I used to trade currencies, I think there's a few examples of like the Japanese yen versus the US dollar, etc., etc. And what it says about my trading then is where other amateurs or newbies, so to speak, would have lost money in the market, I made money in the market or broke even because of that strategy that I just showed you. 2 units, and you're kind of going, okay, we anticipate this big move, but we understand its probability is never certainty, so we need to manage our risk on the downside. So if you want to learn how to do Fibonacci, Elliott Wave, I've broken it down to simple layman's terms. Take my free Elliott Wave Fibonacci Masterclass. Really, we get some brilliant feedback, but we put 90% off the course. So at the end, you go, hey, I like this, I want to learn. It's only £97, but it's broken down from Foundation, Intermediate, Advanced on Elliott Wave, Foundation, Intermediate, Advanced when it comes to Fibonacci price. And the two coincide because we're measuring waves within the waves and the relationships that they have with each other. So if you like today's video, like, subscribe, hit the bell notification. Let me know how you found today, because today, most people ignore risk management, right? And I'm reading your comments all the time, and people at all different levels. So here we go. We're going to finish on a quote today. It is from Benjamin Franklin. He who is good for making excuses is seldom good for anything else. Now, I don't know how many times I say it within each video, but it's probabilities, never certainties. Probabilities, never certainties. Guess what? Probabilities, never certainties. I would never say that the market is going to hit, is likely to hit, or has a high probability to hit. But we need to protect ourselves from the opposite occurring. And what's the minimum that may occur and should occur if we're wrong? And even if we're totally wrong and it doesn't even do the minimum, what's our risk? What's the amount percentage-wise and monetary-wise that we're willing to risk to find out? So if we are right, we make good gains. If we're wrong, we mitigate the risk. Or if we're partially right, we still make a small profit. And it's all about having the capital to play another day. You never put all your chips into one. Like if someone says, I'm all in on this one, I'll go, wow, unless it's a particular kind of strategy that you're looking at, 10-year, 20-year, or it's, just like I'm going to buy Bitcoin and never sell it kind of strategy. But when it comes to swing trading and really leveraging the bull market, you have to get a bit more sophisticated and write down your plan and then trade that plan. If you like today's video, let me know what you think. It was a bit different, I know. Like, subscribe, hit the bell notification, and I'll see you soon.